Listen carefully. Your spouse passes away. The funeral ends. The relatives go home. The flowers start to wilt on the kitchen counter. And for the first time in decades, the house is quiet in a way you do not recognize. Then the paperwork starts. The bank wants a death certificate. The brokerage company wants account forms. The retirement plan asks for a beneficiary claim. The insurance company wants documents. And the home you built together is suddenly not just a home anymore. It is a deed, a title, a tax basis question, a probate problem. This is where many surviving spouses get trapped. Not because they were careless, not because they were rich, not because they were trying to avoid taxes, but because nobody explained what should have been reviewed before one spouse passed, before the hospital bed, before the funeral home, before the first letter arrived in the mail. There are 4 assets every married couple should review while both spouses are still alive. The home deed, the taxable brokerage account, the IRA or 401k, and the bank accounts, CDs, and life insurance beneficiaries. Each one looks normal while both spouses are alive. But after death, each one can turn into a different problem. Taxes, frozen accounts, wrong beneficiaries, probate delays, capital gain surprises, or an IRS form nobody knew existed. And I want to be clear, this does not mean you should panic transfer everything today. That mistake can make the IRS problem worse. This is general education, not legal or tax advice. The point is not to move blindly. The point is to review carefully. Because when a spouse dies, grief is heavy enough. Your family should not discover the financial trap after it is too late. Here's the part most families miss. These assets are not dangerous just because they exist. They become dangerous because each one follows a different rule after death. The home follows title, not memory, not who paid the mortgage, not what the family assumed. The deed decides how that house moves, whether the court gets involved, and whether the surviving spouse is left proving ownership while grieving. The brokerage account follows basis. That word sounds small, but it can decide how much tax is owed when investments are sold. A stock account that grew quietly for 20 years can become an IRS problem if it was transferred at the wrong time, titled the wrong way, or recorded with missing cost basis information. The IRA, or 401k, follows the beneficiary form. That form can be stronger than what everyone thought the will said. If the wrong person is listed, if an ex-spouse is still there, if the estate is named wrong, or if no one checked the form in years, the surviving spouse may lose options they would have had. And cash accounts, CDs, and life insurance follow access. This is the one families feel immediately. The funeral home wants payment. The mortgage is still due. The electric bill still comes. The property tax notice does not wait for grief. But the bank may say, we need documents. We need proof. We need the estate processed. Suddenly, money exists, but the surviving spouse cannot easily reach it. That is why the real review is not just, what do we own? The real review is, who controls it after death? How does it pass? What tax record follows it? And who can access money when the bills arrive? Title, basis, beneficiary, access. 4 rules. One spouse dies. And those 4 rules decide whether the survivor gets breathing room or a financial maze at the worst moment of their life. Now, before we look at the home deed, understand this clearly. The word move in this video does not mean panic transfer. A rushed move can create the exact IRS trap you are trying to avoid. They hear one sentence from a neighbor, just put the house in your kid's name. They hear one sentence online, just add someone to the bank account. But taxes do not follow casual advice. Deeds do not follow emotion. The paperwork follows the paperwork. The safest first step is not a signature, it is a review. So let's start with the asset that creates the most pain after a spouse dies, the home deed. The first asset is the home deed, not the house, the deed. Because your family may see the house as 40 years of marriage, the IRS sees records, the county sees title, the court sees ownership. And after one spouse dies, those details matter more than most families realize. This is where the dangerous shortcut begins. Just put the house in the kids' names. It sounds loving, it sounds organized. But if that move is made the wrong way before death, it can trigger 2 traps at the same time. First, the IRS trap. A home bought decades ago may have gone up by hundreds of thousands of dollars. If that home passes after death, the tax basis may be treated differently than if it was gifted away during life. But if the house is transferred to children too early, the family may carry the old basis. Then, when the house is sold, the capital gains tax may be much larger than anyone expected. Second, the Medicaid trap. If one spouse later needs nursing home care, giving away the house inside the look-back period may create a penalty. That means Medicaid may delay paying for care while the nursing home bill keeps running. And the rules are not the same everywhere. A couple in California or Texas may face a different property system than a couple in Ohio. That is why copying another family's deed is dangerous. The real question is not, should we put someone else on the house? The real question is, how is our home titled right now? What happens when the first spouse dies? And what happens if care is needed within 5 years? Before anyone signs a deed, bring that question to an estate attorney, elder law attorney, and tax professional. Because the wrong deed does not just change a name on paper. It can turn the family home into a bill after the funeral. The second asset is the taxable brokerage account, not the IRA, not the 401k, the regular investment account, the Vanguard account, the Fidelity account, the Schwab account, the account holding stocks, mutual funds, ETFs, or bonds that quietly grew for years. This account looks simple, but after one spouse dies, it can become one of the most confusing tax files in the house, because the IRS does not just ask, how much is it worth? The IRS asks, what is the basis? In plain English, basis is the tax memory attached to the investment. What did you pay for it? What gain exists if it is sold? Now imagine a couple bought investments years ago for $50,000. Today, that account is worth $300,000. That growth feels like success, but it also means there may be $250,000 of gain sitting inside the account. If that account passes correctly at death, some or all of that old tax history may be reset, depending on the rules and how the account is owned. But if you move the account the wrong way before death, just to get it out of your name, the family may drag the old basis with it. Then, when the surviving spouse or children sell later, they may face a tax bill that careful planning could have reduced or avoided. This is where casual advice becomes dangerous. Someone says, just transfer the account now. But a brokerage account is not just money, it is tax history. Every stock position has a record. Every mutual fund has a cost. Every sale can create a capital gains question. And if the surviving spouse does not know where those records are, grief turns into detective work. Old statements, missing passwords, unknown purchase dates, a tax preparer asking questions nobody can answer. So before anyone moves a brokerage account, ask one very specific question. What tax basis follows this account if my spouse dies first? That question belongs with a CPA and estate attorney, because this account does not just hold investments. It holds the IRS memory of every dollar your family forgot to track. And if you thought the brokerage account was complicated, the retirement account follows completely different rules. The third asset is the retirement account, the IRA, the 401k. The old workplace plan nobody has logged into for years. This asset does not follow the same rules as the house, and it does not follow the same rules as the brokerage account. A retirement account follows the beneficiary form. That one page can decide who receives the money, how fast they may have to take it out, and what tax choices the surviving spouse may still have. This is where families get blindsided. A husband thinks, my wife gets everything. A wife thinks, our will already handles it. The adult children think, Dad told us what he wanted. But the retirement company does not follow kitchen table conversations. It follows the beneficiary form on file. And sometimes that form is old. Sometimes it names the wrong person. Sometimes it still names someone from a first marriage. Sometimes it names the estate. And sometimes nobody can find it until after the death certificate is already on the table. That can be a serious mistake, because a surviving spouse may have options that children do not have. A spouse may be able to treat certain inherited retirement accounts differently depending on the account and the rules. But if the wrong beneficiary is listed, those options may disappear. Now imagine this. There's a $300,000 IRA. The surviving spouse was supposed to use that money for living expenses, property taxes, medicine, home repairs. But the form names the estate, or it names the children directly. Now the account may be pulled into a completely different process. Different tax timing, different withdrawal rules, different family pressure, and the widow who thought that money was there for stability may be left asking why one unchecked form overpowered the plan everyone assumed was in place. So before a spouse passes, do not just ask, how much is in the IRA? Ask, who is listed on the beneficiary form right now? Not 10 years ago, not before the second marriage, not before the last grandchild was born. Right now, because retirement accounts do not care who loved whom. They follow the form, and the next asset follows something even more immediate, access to money when the bills arrive. The fourth asset looks the simplest. Bank accounts, CDs, money market accounts, and life insurance policies. This is the money families expect to be available immediately. The funeral needs to be paid. The mortgage does not stop. The utilities still come. The property tax bill still arrives. Medicine still has to be picked up. And the surviving spouse is still living in the same house with the same bills, but now with one income missing, often dropping from 2 Social Security checks down to 1. That is why access matters, because money can exist and still be difficult to reach. A bank may need documents. An account may be titled in a way nobody understood. A CD may have no clear payable on death instruction. A child may have been added as joint owner without anyone understanding what that legally means. Or a life insurance policy may exist, but nobody knows the company, the policy number, or who the beneficiary is. This is where families panic. Not because there is no money, because the money is behind paperwork. And paperwork does not care that the funeral was last week. It follows names, it follows forms, it follows beneficiary designations. So before a spouse passes, this asset does not need drama. It needs a clean access map, a joint account that makes sense, a payable on death instruction where appropriate, a current life insurance beneficiary, a backup beneficiary, and one folder the surviving spouse can actually find. Not 6 scattered conversations from 20 years ago, one clear map. Because after death, the most painful sentence is not always, "There's no money." Sometimes it is, "There's money, but we cannot reach it yet." And that delay is what makes the next trap so dangerous. Because while the surviving spouse is trying to unlock the accounts, another clock may already be running quietly. A hidden IRS deadline most families never see coming. Now we get to the trap almost nobody sees. Because while the surviving spouse is dealing with the funeral, the bank, the insurance company, the house, and the retirement account, another clock may already be running, an IRS clock. This is where families hear a dangerous sentence. We are not rich enough to worry about estate tax. And sometimes, for federal estate tax, that may be true. But that does not always mean there is nothing to file. There is a rule called portability. In plain English, portability may allow a surviving spouse to preserve the unused estate tax exemption from the spouse who passed away. That unused amount is often called DSUE, Deceased Spousal Unused Exclusion. The name sounds technical, but the mistake is simple. The family assumes nothing needs to be done. But portability is not automatic in every situation. The estate may need to actively elect it by filing an estate tax return. And the standard deadline can be 9 months from the date of death. Extensions may be available, but only if someone asks in time. That is the part families miss. Usually, they are not thinking about IRS Form 706 while choosing flowers for the funeral. They are not thinking about estate tax elections while trying to unlock a bank account. They are not thinking about a deadline while learning how to live alone. But the clock does not wait for grief. And if nobody asks the question early, the surviving spouse may lose a tax shield they could have preserved, not because they owed estate tax that day, but because nobody filed the right form on time. So, after the first spouse dies, one question should be asked early. Do we need to file an estate tax return to preserve portability? That question belongs with an estate attorney and tax professional soon after the first spouse passes, not months later when the calendar is already closing. Because this is what separates two families with the same loss, but very different outcomes. Now picture two couples, same savings, same home, same fear of leaving one spouse behind. Family A loved each other, but they never reviewed the deed. They never checked the beneficiaries. They never organized the brokerage basis records. They never made an access map for the bank accounts and insurance policies. So when the death came, grief was only the beginning. The widow had to search drawers for statements, call banks that wanted documents, find passwords nobody wrote down, explain old accounts to a tax preparer, and sit at the same kitchen table where they once planned retirement, now surrounded by paperwork that felt like a second funeral. Family B did not avoid grief. Nobody avoids grief. But before the first spouse passed, they reviewed those 4 assets. The home deed was checked. The brokerage records were organized. The retirement beneficiaries were updated. The bank and insurance documents were placed in one folder. The loss still hurt. The house was still quiet. The chair across the table was still empty. But the surviving spouse was not forced to solve every financial question from scratch. That is the difference planning makes. It does not remove the pain. It removes avoidable confusion. The goal is not to make everything perfect. The goal is to leave the surviving spouse with fewer locked accounts, fewer tax mistakes, fewer deadline surprises, and fewer moments where they whisper, "I wish we had checked this sooner." So here is the calm step. Not panic, not fear, not signing documents because someone online made death sound urgent. Just one review before your family is forced to do it in grief. Take out a notebook. Write down 4 headings. Home deed, brokerage account, IRA or 401k, bank accounts, and life insurance. Under the home deed, write whose name is on it, how is it titled, what happens when the first spouse dies, and what happens if nursing home care is needed within 5 years. Under the brokerage account, write who owns the account, what tax basis is attached to the investments, are the cost basis records complete, and where are the statements, passwords, and account documents. Under the IRA or 401k, write one question in large letters. Who is the beneficiary right now? Not who you think it is, not who it should be. Who is listed today? Under bank accounts and life insurance, write, can the surviving spouse access money quickly? Are beneficiaries current? Is there a backup beneficiary? And can the documents be found without searching every drawer in the house? Then ask one more question. After the first spouse dies, do we need to ask about IRS portability in Form 706? That question may not apply to every family, but it should not be missed because nobody knew to ask. And these are not questions to answer alone. Bring this notebook to an estate attorney, elder law attorney, and tax professional in your state, because this is general education, not legal or tax advice. The goal is not to hide money. The goal is not to outsmart the IRS. The goal is to protect the surviving spouse from confusion, frozen accounts, wrong forms, and avoidable tax mistakes. Because when one spouse dies, the house will already feel empty enough. The paperwork should not make it emptier. If this helped you see the trap before it happens, like the video and subscribe to Seniors Heaven for plain English guidance on retirement, estate planning, Medicaid, Medicare, and the financial rules families usually learn too late.